Hi, everybody. Welcome back to our weekly updates with myself, Tim, and my colleague Billy.
Hi,
So
Tim.
this week we'll be covering Singapore bank earnings because the three big Singapore banks have been reporting their earnings over the past 2 weeks. Um, with rising rates with the from the Federal Reserve, I think a lot of these banks were expected to post pretty solid strong net profit numbers, and I think they did across the board. So I mean, what was your big takeaway from the earnings season for banks, Billy?
I think of the three banks, I think the biggest surprise was, of course, OCBC. I think the net income margin was higher than expected. So, in fact, I think they actually recorded. Initially, I thought it was DBS, but it turns out it was OCBC that has the highest increase on a quarter-on-quarter basis in terms of the net income margin. So that just shows the upside that OCBC has. On an overall basis, I think, like you said, all the three banks are expected to perform well, and they didn't disappoint. I think that's part of the reason why we can see the Singapore Straits Times Index that remain resilient despite the sharp decline, in global stock market. So that's really the positive news on the front. I think another thing to take note of is if you look at across the board, I think all the wealth management services were affected, but it was mitigated by the increase in the treasury income side. So on an overall basis, I think we should expect this to continue as long as the US Fed maintain that aggressive hike path. I think until we see the Fed's pivot, the banks, especially the Singapore banks, will really benefit from it. It's really not just the interest rate increase itself as well. I also think it's also because of the reopening of the in the region, and Singapore banks are one of the key beneficiary of this. So, and we haven't even seen the reopening from China, so that's another positive going forward. So I think that's really good news for the banks that we saw in Singapore. Yeah.
Yeah, I mean, obviously they're all geared towards growth in Asia. So I mean, my takeaway was that DBS and OCBC are a bit more positioned for a rebound in China and North Asia because they've got more business focus there, and then obviously UOB and its business franchise in Southeast Asia is pretty geared towards reopening in Southeast Asia and the business cycle here. So I think, the net interest margins and net interest income were all up strongly, but as you said, the fee income was pretty stagnant or down, the non-interest fee income.
Yep.
So I think that was something to watch, and I think management teams across the banks were very cautious in their outlook for the last quarter and then the first half of next year, because there is a very real possibility rather of a recession in the US, given how fast rate hikes have been implemented, right? So I think there's some worry that net interest margins might peak in the first half of next year and then start to come down if there's a rate pause or if there's even a cut sometime next year. So I mean, so do you think they're being responsible in terms of their guidance? It's pretty conservative, right?
I think so. I think it's quite conservative in terms of their guidance as well. I mean, if you look at the results that they have, the loan growth momentum remains pretty healthy. I think it's good. And the fact that they are giving that sort of guidance, I think it's just precautionary. They are taking that precaution to guide investors, especially when we talk about a potential recession. Not just I think if US has the recession, it's probably going to spill over the rest of the world. So So I think that pretty much helped investors to sort of position themselves rather than over optimistic on the upside of these of the banking sectors.
Yeah, and the dividends, I mean, there were no dividend announcements from OCBC or UOB, but DBS, I know, maintained their dividend. So I don't think there are any worries about dividend payout ratios. I think their earnings this year will be quite strong. So going into the back half of this year or the final quarter, I think all three banks' payout ratios are probably in the range of 40 to 55% or so. So they will comfortably be able to cover those dividends next year as well, I assume.
Yeah, I mean, even on the NPL side of things, I think it also looks pretty stable and healthy. Of course, I do wonder how it would look like, I mean, in terms of, especially with China's outlook, and if things were to deteriorate in China, I wonder how this would actually affect some of the Singapore banks. But at this juncture, is still pretty decent.
Yeah. Yeah, and I think they've also benefited from a relatively strong Sing dollar as well. And I think Asian currencies have held up okay against the Singapore dollar, not too bad. So I think their businesses are still growing. I know UOB is closing soon on the Southeast Asian franchise of Citibank,
Oh yeah.
which they agreed to earlier this year, and DBS is probably going to be closing, I think, in the first half of next year on the Taiwanese assets of Citibank. So DBS and UOB still growing with a couple of acquisitions. So I think there's still a bit of growth left for these banks, and the return on equities were all at record highs as well. I think in the latest quarter,
Yep.
I saw DBS was at close to 14 or 15%, and the rest, in the 12 to 13% range. So pretty impressive quarters for all three banks.
Yeah. Which is your favorite team of the three?
Personally, I like the biggest and the baddest, which is DBS. I think it's just more geared towards the rising rate environment. It's CASA, which is the CASA ratio, is the current account savings account, is the biggest. They got the biggest deposit base in Singapore. So I think their funding costs will be lower. And so I think they're best positioned in terms of the tailwinds from rising rates. So I think from that perspective, I like it. I like that bank the best. And also, I think if there is a China reopening, obviously everyone's questioning whether there will be, and so no one knows.
Yeah.
But if there is, they are best positioned again to benefit and rebound from that, given their presence in sort of Hong Kong, China. So I think it's I think they cover all the bases quite well. But I think all three banks are really solid. They've all got very good fundamentals. But my personal favorite is DBS. How about you, Billy?
I think in terms, if you look at the numbers, DBS definitely has the upside, like you mentioned, right? I think there will also be the key beneficiaries from the rising interest rate. But I do like OCBC as well because of also their insurance business. I think that's also pretty solid. So, yeah, but I think I agree with you. I think DBS would probably be the best if you have to choose among the three, right? And just one more thing to ask. I mean, I think we saw the cryptocurrencies. Among the three banks, are there any that really get opening up themselves to looking at digital assets?
I think with DBS is actually got a sort of blockchain exchange that they've opened in Singapore, but that's only for institutional investors, or crypto exchange rather. So it is a growing asset class, but I don't think any of the three banks have too much exposure to crypto as a in terms of their loan book or in terms of their liabilities. So this whole crash with FTX and the whole meltdown, I think, in markets right now is more scary for the asset class. But because it's still a relatively nascent asset class in terms of mainstream finance, I think it should be relatively contained, the fallout in terms of share price action. I don't think it should affect the banks really that much.
Okay. Yeah, I just wondering because I was just following the news today. So
no, it's been interesting. It's interesting. One more thing I would mention on banks is Singapore banks. Yeah, I guess DBS I like again because they also pay a quarterly dividend. Whereas UOB and OCBC only pay it twice a year. So I think in terms of if you're one who reinvests your dividends every quarter, I think it probably, you can compound that at a faster rate with a quarterly dividend. So that's something else to consider as well.
Yep, true.
Yeah. Okay. Well, thanks for joining us today. Next week we'll be back with our weekly updates for more market leading news. So thank you, Billy, for joining us today, and thanks for everyone for taking your time out to watch. See you next week. Bye. Bye.